flying high with GameStop. Meanwhile, shares of biotech are surging. The top two had doubled either earlier in the day or yesterday. That third stock notably was up some 30% and then gave back all its gains and then some, showing that volatility remains in this Reddit army, but they continue to have an impact on stocks. Meanwhile, quickly to the Bloomberg, it shows that the restrictions that Robinhood, the online trading broker, put on AMC, GameStop, and other related stocks touted on the website and message boards had impacted the decline. In fact, a lot of Reddit-related traders are blaming Robinhood, calling them the bad guy. To quote one trader, they saw the army coming and they stopped us. Meanwhile, Robinhood in the bullseye of a lot of scrutiny over what went down in the past few weeks.
And Sue, in fact, U.S. regulators now giving us a little bit of insight on how they see what went ahead in the past few weeks in terms of volatility in the markets.
Yeah, in the meeting today, Yellen wanted among the regulators the CFTC, the SEC, and the Fed New York Bank of New York. And then she issued a statement after their meeting saying that the regulators believe the core infrastructure was resilient during high volatility and heavy trading volume. And she's referring, of course, to that huge run-up in GameStop. And to continue the quote, the participants in the meeting agree on the importance of the SEC releasing a timely study of the events. Remember, we had already reported that the SEC was said to be looking closely at whether there was market manipulation. Back to you.
Right, Bloomberg Sue Keenan there. It's been a painful year for Shell. Those are the words of the company's own CEO, Ben Van Beurden. On Thursday, the oil giant reported net income short of expectations and weak cash flow. Speaking exclusively to Bloomberg, Van Beurden said the company's numbers are still resilient and he expects oil supplies to tighten as the economy recovers.
The year was a very tough year, let's be honest, and a very painful year.
How come earnings missed the street's expectations? Why did these analysts, did they get ahead of their skis here, or did you have some last-minute accounting changes that surprised them?
Well, it's probably a combination of a number of factors, I would say, Matt. But listen, you know, at 0.4 billion versus 0.6, the absolute delta is, of course, very small. Percentage-wise, these numbers are magnified because we're talking about low numbers, and it's very, very difficult with a lot of, indeed, adjustments, and we did have a number of deferred tax asset adjustments to get it completely right. I thought the street did a pretty good job to come as close as $150 million on average from where we were in the quarter. Now, if you look at the entire year, though, I think it's probably more sensible to look at that. And again, $34 billion of cash, because that is, after all, the better measure for us to be measured on, is, I think, a credible and a resilient performance. On top of it, Matt, I would say that the countermeasures that we took early in the year, early in 2020, when we said we were going to find $8 to $9 billion of cash to help us in these difficult times, we actually delivered $11.5 billion. So I think we did well in that respect. It didn't help us from taking the painful decision to also reduce our dividend and rebase it. But I think if you look back operationally over the year, I think our staff did remarkably well. I'm very proud of them.
Yeah, let me ask you about how shareholders have received all of the messaging you've given around the dividend and buybacks. You took that historic decision to cut the dividend, the first time in many decades. That was just last year. A couple of quarters later, you raised it modestly, and you also committed to further buybacks. Have investors kept with you along this journey? What's the feedback been from investors?
Well, and as you can imagine, there's a range of reactions. I think nobody, and certainly also not the company, welcomes the need to reset a dividend. But at the same time, it was also a necessary and inevitable thing to do to not only preserve the financial resilience of the company, but also to preserve the long-term future of the company.
Capital expenditure by oil companies, by oil and gas companies, is at historically low levels. Do you think the sector is investing just enough to avoid a supply crunch? Could we see a spike in prices as a result of this phenomenon over the near term?
I think it's a very good question, and I think it depends a little bit on the time frame at which you look. At the moment, of course, we see pretty good oil prices. I think it's approaching $59 today, Brent. But I think that is probably much more driven by short-term factors. Demand is not back where it was a year ago, but then again, we see a lot of discipline also from OPEC Plus, and therefore the market is being held in balance quite well. If you look at the slightly longer term, yes, we're not the only ones, of course, who has cut back on our capital spending. We went from a plan of $25 billion to spend in our entire business, but not just in oil production, to $18 billion. So that's a $7 billion drop. And as I said, we're not the only ones. So fast forward a little bit, and yes, indeed, I would imagine in the second half of this year, we're beginning to see not only recovery, but we're beginning to see a little bit of tightness in the market appearing. And I believe indeed that next year, when the recovery is probably complete, and in the years thereafter, it could well be that we see a tightness in the market that will provide for more upside pressure on the oil price.
Shell CEO Ben van Beurden there speaking to Bloomberg's Matt Miller and Anna Edwards. Coming up next on Daybreak Asia, our global economics and policy editor Kathleen Hays will be speaking to a great guest ahead. Kathleen.
Yes, that's right, Heidi. After the break, I'll be joined by Kansas City Fed President Esther George to discuss her outlook for recovery, the importance of bringing more diversity to the Fed. This is Bloomberg. Welcome back to Daybreak Asia. I'm Kathleen Hays in New York. We want to welcome Bloomberg television viewers and radio listeners all over the world. I'm joined now by Esther George. She's president of the Federal Reserve Bank of Kansas City for an exclusive interview. And warm welcomes to the show. We're glad to have you today.
Thank you, Kathleen. Good to be with you.
Yes. And I want to start with the economy. I know you're confident that it's going to continue recovery this year. You said that a couple of weeks ago in a speech. We've seen now some signals that maybe growth is picking up a bit. 3 weeks of jobless claims falling, the ADP private job gauge. More strong than people were expecting. The ISM manufacturing and services gauges remaining strong. Do you think with the stimulus that was passed at the end of last year and the fact that viruses are coming down now, the cases are, the economy is picking up some steam?
Yeah, Kathleen, I think it's encouraging the progress that we've seen in the economy, the supports that have been provided to this point. I think around all of that, of course, we can't forget that the real driver of the outlook continues to be the virus. And as we